there are market effects, and then there are what I refer to as profit mechanisms. Market effects are things that happen in the market, either sometimes or always. And then profit mechanisms are versions of those effects that you can monetize. So a great example of a market effect that is also a profit mechanism is something like momentum. But then there's also other market effects that you cannot functionally monetize as a retail trader.
Sitting down today with Eric from Outlier Trading. Eric, it's good to talk with you again. And we had you in the podcast. It's probably a few years back. So good to have you here back on the podcast. And looking forward to talk trading with you.
Yeah, man. Absolutely great to catch up. I think it was a little while ago, which is always kind of fun. A chance to see, it's like a snapshot in time, right? Like see how things have progressed since. Today was fascinating in the market, like a 3.8 standard deviation down move in S&P, which always scares the children. Pretty fun. But yeah, looking forward to catch up.
Kind of fill me in on what's been going on since we spoke. I think it's been a year or so ago or more. So kind of what are you working on these days?
Yeah, so there's been a couple projects that have came across my sphere. Like I was explaining right before we went live, I first started building wealth through trading. But in order to build that initial capital, I used to do a bunch of different things. And one of the things I used to do is actually angel invest. So some of it was just hard money lending. Some of it was I had a guy that I lent capital to and then I advised on it's like an entertainment business in Dubai, which was super, super cool. But so I've always enjoyed that because I've identified a long time ago, unfortunately, I wasn't blessed with the good idea fairy. I'm not the guy thinking of cool businesses, but I always love to get involved in them and learn from them. It's one of the reasons why I was a consultant with Deloitte. Is after Marine Corps, did that for a couple of years as a chance to just see businesses and learn. So I've been doing a bunch of that and then a lot of siphoning capital into other return profiles. Like I was explaining, once the account gets to different thresholds, I typically just take pieces of it out and then I put it into other investment vehicles, specifically to diversify the overall return profile. As you know, trading, especially as a primary income source, if you build out a good system, it really is pretty simple. But nonetheless, it's a singular system, right? I think about during 9/11, I wasn't trading then, but during 9/11, the market closed for several days. That's a real thing. That can happen. So I really think about robustness in the way that I try to set up my overall income profile. So that's a big part of it, which has been getting more and more into commercial real estate, which is just a fun different way to look at stuff. So yeah, kind of been bouncing around and then trading as usual. This year has been absolutely fantastic. This will so far, I've already beaten my prior third best year, and this will probably end up somewhere around my third best year, I think. I don't think it'll top the last 2 years, at least not with the current pace.
I think a lot of traders don't think about finances and wealth overall enough. They think about trading and kind of being in the market, making money, but they don't see the bigger picture of things. And that's kind of where it's interesting to hear what you do with your trading profits and kind of how you manage it as part of a bigger picture kind of portfolio.
Definitely. It's funny because it's something that you don't typically think about until you find yourself in this scenario, right? Because to your listeners' credit, and I fully identify with, for a long time, I was just worried about making money, right? I wasn't really thinking about how do I optimize my holdings? How do I reduce my tax footprint? And all of those really, really boring things that actually start to matter as you hopefully accumulate wealth. So it's one of those things where it doesn't really matter until it does. And then at least for me, I was just damn, I wish I thought about this a little bit more, because then it was crash learning. I was paying different people to just sit down and talk and learn a lot. So yeah, it's something I would say learn at your convenience, but the near-term fight for most people is to build that first layer of wealth, and rightfully so. But just definitely be aware that once you do that, there is a little bit of another game that happens in terms of like optimization and building just robustness in the model.
Some people would say if you make money trading, why do you have to invest in other things? Why not just put all your money into trading and kind of making more money that way? Because that's your best skill set at this point.
It's a really, really logical conclusion that is completely illogical once you actually think about it. So let's say, unfortunately, let's say that I'm driving and I get into a car crash. I'm probably not managing my book the same way that I do now, if at all, depending on how serious the injury is. There's also, as I was mentioning before, the dependency on a single system. Right now, we take and benefit the fact that the market is typically open, typically liquid, and you can interact with it very easily. But as I was mentioning before, during a time like 9/11, the entire market was shut for several days. So there are instances that you can identify some level of weakness in those systems. Now, it's always a game of like figure out the optimal growth curve, almost like a Kelly criterion in terms of like what gets your money where. But the other thing to keep in mind is that from a trading lens, there are very, very few tax benefits, at least if you're in the US. I actually think for some other places, it's even worse. Whereas stuff like real estate has actual tax benefits to it. There's things like 1031 exchanges, which a lot of people don't know about. It's kind of like a way to defer capital gains, but it's a way to massively compound your wealth. So there's that component. And then, as I was mentioning before, there's just the reality that I never want to be like the single point of failure. That's a big thing in the military that you avoid is single points of failure. And if all I do is trade, I am now the single point of failure for my family. So if anything happens to me or my system or what I do, then our entire income profile changes. Single point of failure, no good. When you're growing, you accept that risk because you just don't have the capital to put into a bunch of different things and have them be meaningful contributions to your income. But over time, that changes. So there's actually a lot of efficiencies to be gained by branching out, even though those efficiencies don't always look like top line performance. So one last point on that. On your income when you trade, again, depending on your tax footprint, but for most people, if your short-term capital gains rate, it's going to be passed through, and then it's going to be taxed at whatever your bracket is. If you're a high-income earner, at least, again, in the US, and I live in a state like California, like the effective rate is like up to 54% on like the top bucket. So not only do you have to outperform a benchmark, but you literally have to outperform it enough to compensate for at least some of that, what you're giving up in taxes, which really raises the threshold in terms of like what you really need your returns to be for it to be logical. So a really long, nuanced answer, but it's really a nuanced question that has to be thought through with respect to like what makes sense to the individual and their individual profile, for sure.
What do you think is a point where you should start to focus on that kind of stuff? Like, because you mentioned, yeah, of course, like when you grow, when you build that skill, you don't want to be diversifying into all these kinds of things. But what's the point where it makes sense? You have enough money to do that.
I think it's when you get to the point where you find that you have excess. So, for example, on the way that I think about trading for primary income is never the case where it's like whatever I make this month is what I'm using this month to live on, right? Like that's a terrible plan. So the way that I typically think about it is having at least 3 years of a buffer now. It wasn't always 3 years, but that's effectively when I realized that, okay, there's a little bit of slack here because I originally started with a 2-year runway. And then I started saving my way out to a 3-year runway with increasing monthly expenses. So then you kind of find yourself with a little bit of a surplus. So is what I'm doing the maximal growth trajectory? No, it's not. It's objectively not. But even the way that I trade is not built for maximum growth. The way that I trade is really built for robustness. So I think when somebody finds themselves able to meet all their daily needs, they have enough of a savings buffer, and then they find themselves able to continually pad what they're doing, then I think it can be completely logical. Because there's, again, depending on what other asset classes that you get into, especially stuff like, let's say, for example, angel investing, a lot of these companies aren't liquid, right? Like there is no exit. You need some sort of liquidity event in order for you to even be able to pull anything out. So a lot of the money that goes into stuff like that, in effect, goes in that to quote unquote die until you can actually pull it back out, which can be a super long time. So I think keeping all of those details in mind matter, but it's when you start seeing excess, I think is when it makes sense to start looking at other things. One other caveat I guess I would mention is if there's a really great opportunity that pops up. Every once in a while, depending on what kind of feelers you have out and what kind of just network you build with other investors, you'll find really cool opportunities pop out once in a while that might not be optimal, but they still make sense in terms of risk and reward.
If you are enjoying this interview so far, then I think you'll like this one over here. I've been working on this book for a long time called Prop Trading Secrets. It's finally out. You can get it in your favorite bookstore or on Amazon, Barnes & Noble, of course. And this book is really about interviewing traders who are successful in either trading for prop firms or managing their own private fund. We talk about their background, what makes them successful, the things they went through, struggles they had to go through to become good traders now, and a lot of the good wisdom that you might not necessarily hear about, but it's all into a condensed version over here. You can read through these stories, get inspired, of course, learn a lot about what they do, their strategy as well. And we summarize everything at the end where we have a whole chapter of summaries of what these traders have in common. So if you want to check it out, 14 traders in this book that myself and Kathy Lean interviewed. There's a lot of good wisdom in this. If you like these interviews on YouTube, I'm sure you like this one for sure. Go grab it. Like I said, it's on Amazon, Barnes & Noble, it's on Audible in audio version. All the other audiobook platforms will have it too, or your favorite bookstore. So check it out. If you did read it, let me know in the comment section below which one is your favorite chapter, and we'll get back to the interview. You mentioned something interesting here, which is how does trading for robustness differentiates from trading for growth? What's the difference there in the way you trade or the way you manage it?
I think a lot of people focus a lot in terms of how can I make as much money as I possibly can. I personally have found that that doesn't tend to perform well for me. And I think it's for a lot of different reasons, but it generally comes down to needing a ton of exposure in order to do that. So the way that I think about trading is more so in terms of how can I do something that is extremely consistent and reliable as a baseline, and then attempt to return in excess of that. So an example of this, when I first started trading, my target was 15% per year, which doesn't sound like a whole lot. The beauty of that metric is that it gives a slight edge over the long-term CAGR, compound annual growth rate, for something like S&P. And if you can essentially always get that return, when the market inevitably has its 20% down year, that places you so far ahead that you can even lag a couple really good years and still come out ahead. So one of the things that doesn't work super well is when you're trading, again, for a primary income source and your overall just wealth is parabolic, shooting up and down. That's real difficult to manage emotionally, and then also to be able to plan off of that. So I've always really focused my trading on pursuing a baseline return and then being selective in terms of taking shots and pursuing opportunities in excess of that return.
You mentioned a kind of roller coaster equity curve, which can be a problem for some people. Do you prefer to pay expenses from trading income or from other investment income?
It's a good question. It kind of depends because I guess for me, it all just becomes one pool anyways. Yeah, so I would guess the way that I think about it is it's kind of the same. I'm actually curious for you. How do you go about drawing income? Do you do it standard couple times a month, or do you do it once a month periodically?
Yeah, so all my trading income goes into of course, a SEM account, but then I kind of use it for investment, and some of it I invest in the market. So basically, I don't use my trading profits for my expenses. I'll put into investments first, and then these investments pay for my income because it's very, very stable. And that kind of makes more sense for me. Yeah.
Got it. Yeah. No, that makes a ton of sense. It's fascinating to see how different people do it because, yeah, I mean, I essentially, when it comes to investments, at least in the portfolio, I hold next to nothing. Like all of my stuff is trading. And then most of the investments are done in like physical investments, again, like real estate and stuff like that.
What's the advantage of real estate or these physical investment compared to, let's say, the stock market? Like, why not just buy ETF or like treasury bills and kind of use that for investments?
I think for a lot of people, that's really, really good. Honestly, it makes a lot of sense to just keep it super simple. An ETF is as simple as it gets. But again, like once you start creating more wealth, you have to think about things a little bit more tactically in terms of your ability to maintain it. So the first thing is it's just a non-correlated return source. Although my portfolio has different strategies that also have different correlations with one another, I still have a completely disparate income source that's not attached to the markets as a system at all. The other thing is, as I was mentioning before, there are tax benefits for sure. There's things like depreciation, there's things like 1031 exchanges, and so on and so forth. Those tax differences make a huge, huge difference. So again, for example, something that's like a 1031 exchange, your ability to defer capital gains. That's massive because let's say you make $500,000 on a property, you can take that new principal of, let's say you started with 250,000, you double your money in 3 to 5 years, whatever, and then you have a $500,000 property that's worth $500,000. You could take that $500,000, 1031 exchange it into another property that is no tax on your gains at all. So you made 250 grand. There's zero tax on what you've made so far. So it allows you to compound really quick because each time you make a move like that, your initial starting principal for the compounding figure is much higher than what it would be if you had been taxed.
Do you have any favorite strategies for trading, or is it just based on kind of stuff that works for you, or kind of what makes more sense for you to be able to trade for income?
I have a really small suite of strategies. So I have found in the beginning, especially with options, because I do trade a lot of derivatives, options and futures. I specifically find that I tried a ton of different things, which I think you need to do. But there's a handful of stuff that works well for my objectives that I continually iterate. So the way that I view the markets is there are market effects, and then there are what I refer to as profit mechanisms. Market effects are things that happen in the market, either sometimes or always. And then profit mechanisms are versions of those effects that you can monetize. So, a great example of a market effect that is also a profit mechanism is something like momentum. But then there's also other market effects that you cannot functionally monetize as a retail trader. So, for example, every once in a while, you look in the options chain, you'll see something that is actually slightly mispriced, quote unquote, in terms of the bid offer that's provided there. But then you'll find that if you actually try to arbitrage it, that you can't once fees are included. So you can see it, but you can't do anything with it. That's not super common that will happen, but it does happen. In that, I find I split my portfolio into two allocations, a core and a speculative allocation. And then from there, it's just a function of trying to fit whatever the market is doing as best as I can. So some of the specific strategies that I typically lean on are options based. So a covered strangle is one of them, which is a cash secured put plus long shares plus short calls against the long shares at a ratio. Then I trade things like ratio diagonals, which is a way to think about, it's kind of like a levered long or short play. Synthetics, so synthetic long or short is another very, very common. Short straddles, strangles, also long versions of those. And it's kind of like a suite of all of those in their individual components is effectively everything that I do. Then I trade all different kinds of time frames. So I trade a lot of 0 DTE. And then I have stuff that's much longer out in time. So it is really designed to allow me to try and lean into things when they're working and then proxy other stuff to be able to pivot. So like, for example, today is a great example. My base portfolio is down on the day because I'm long deltas, meaning I want the market to go up on the base portfolio. But as soon as I see the market behaving the way it was, I immediately start adding short futures. Part of it is what I refer to as like an opportunistic hedge, not explicitly trying to hedge the portfolio. It's already sized to do that, but it's more so an indirect hedge in that it does benefit and dampen the broad portfolio, but then I'm just trading a short-term move with Delta One products like futures. That's kind of like the broad overview. To summarize all of that, there's probably maybe like 6 to 10 consistent strategies that I run, mostly options based. And then I have a bunch of opportunistic stuff that I'll lay on top, depending on just really what the market's doing.
You mentioned that split between more conservative and speculative. What's that kind of split like? Is it like a 50-50, or is it more like toward conservative, more than speculative, or how do you kind of make that balance?
The way that the core is structured is mostly covered strangles in indices. So pretty conservative, right? So, well, partially conservative because some of them are levered indices, but still an index. So that is like the core piece of the portfolio, which is literally just being net long effectively and amplifying a little bit with options. The speculative is when I'm trying to tackle more dynamic profit mechanisms. So things like trading earnings, zero DTE, short volatility stuff, post earnings announcement drift, momentum, pairs/correlation. All of those go into the speculative allocation. And that's really just a way for me to manage risk because I start with the core allocation. And if I can get the return I need per month with that, I'm going to weight that. Again, back to the conversation we were having about lower risk. If I'm able to get what I need there, then I just use the rest of the capital selectively in the speculative allocation. But there are markets, like the recent bear market we had, that the core allocation isn't doing it, right? The core allocation needs the market to go up. So when we have a bear market that lasts actually a decent duration, then I have to lean more heavily into the speculative allocation in order to hit the return targets that I want, which allows me to trade more stuff to the downside, volatility, stuff like that.
One thing I want to get into is you often talk about having a outlier mindset. Tell me a bit more about kind of what that means and what you're looking into in terms of having a different mindset than most people.
Well, it's funny because the last part you said is exactly what it is. An outlier mindset is looking at things just a little bit different than the way most people look. So for example, I noticed this in the Marine Corps a lot. If you were talking about like a physical fitness test, which is just a thing you have to run, every year to make sure that you're in shape. If you ask most Marines, especially like Marine officers, we literally don't know what the minimum standards are. Like, I genuinely have no clue what the minimum standard is. I've never even cared, concerned, bothered with what the minimum standard is. The only thing that I ever knew was, how do you max this test? Like, what are the best marks you can get? That's a big difference because if you ask a lot of people, they will say like, oh, I just have to get that minimum standard and then I'm good, which is, at least in the way that I view things, insufficient. When it comes to trading, and the reason why I talk a lot about having an outlier mindset specifically in trading is because we know most people fail. So that tells us something right out of the gate. If most people fail, you literally have to do things different than most people. So it's really to make that point front and center for those that choose to approach trading. Because if you approach trading in a way that you find yourself agreeing with a lot of other retail traders, that's honestly probably not a good thing, because the majority will not exist when you look 5 years out from now. That's the window that most will fail in. It's to keep that concept front and center. It's that it's never really about a minimum standard. It's not always about the maximum standard either, to be very clear. It's definitely about being thoughtful with what you're interacting with and setting an approach that likely most other people don't want to do. It's kind of like sitting down on a Saturday and blocking off 2.5 hours if you're learning options to like sit down and read. A lot of people don't want to do that on a Saturday afternoon, and rightfully so. I understand. But again, like that's the kind of activity that isn't going to work well in the favor of the person that doesn't want to do that stuff, but they want the outcome. Most of the work that's done in trading, in my opinion, is always done before you ever click a button. And it's all the preparation, because then trading itself really becomes pretty boring. It's like really, really simple. I don't know. Do you feel that way with the way that you trade, or is it a different sensation for you?
I mean, definitely, it's most of the work is like the setup part. For me, it's like it was like coding indicators that help to find the trades better. So now I just have to show up at the chart and kind of just look at the indicator that I coded for myself, and it works better that way. So it's all the work was done before that, and yeah, the chart time is very, very minimal at this point.
I mean, that broadly aligns with most of the experience that I know of people that actually like do this.
Is there something we didn't touch on or didn't talk about that you want to mention that you think people would get value from?
I think one other thing to mention for folks is the way that you approach trading now is very different than when I started. I started in 2007. There was way less information available, whereas now it's effectively information overload. The biggest thing that I think about for people is sit down and try your absolute best, use AI, make a syllabus for yourself. Like, begin with what your goal is. I want to make 15% per year, whatever it is. How do I break that down? How do I get there? What do I think I need to learn in order to hit that goal? I find people are exceedingly knowledgeable about tons of stuff, but for a lot of people that unfortunately isn't translating into like making money. And it's a decent problem because people are super knowledgeable. But my hope is to try and encourage people to be a little bit more focused with their time, effort, energy, and what they're learning, so that they can like get an observable outcome in their favor from it. So think about sitting down and just literally build a 1-year roadmap for yourself. I want to earn blank percent at the end of the year. So then reverse plan from there. What needs to happen? I think I need to learn these kinds of strategies. I need a strategy that works when the market's going up. I need a strategy that works when the market's going down. What kind of strategies do I think work in those two scenarios? And then just reverse plan from there. But just try to add a little bit of structure to what you're doing, because it's really easy to just kind of get caught going in circles.
It's funny how some people are trying to master everything on like the same day, like all at once. From learning a strategy to managing wealth and everything, you got to take it step by step, and definitely having a plan, I think, or like some kind of framework on how you're going to build things and how when you learn certain things, definitely is a good key there for sure.
I think that that's exactly it, because there's always like that little bit of a comparison metric and like trying to, make sure that you're keeping up and, performing as you should, but it's just a lot. And like we were talking about, it's not a game where it's like you can't find the information. You literally can find information about everything, which is its own problem. Yeah.
Definitely a good topic. Tell me where people can find you and connect with you after this podcast.
Yeah, for sure. You can find me at outliertrading.io. I have a YouTube channel and you guys will find it from there.
Awesome. Outlier Trading, you're pretty much everywhere, so people can definitely reach out to you there. I will put the link below so people can reach out and connect with you. Eric, I appreciate your time here. It's been fun to chat and talk trading, and of course, we can bring you back on in a few months and see where you're at that point.